By the time someone reaches 60, the rules of wealth building change. The goal is no longer to work harder or put in longer hours. It's to make sure money is working harder and longer than you are. At this stage of life, energy is a valuable but finite resource, while time becomes the most important currency. The smartest move is to build a portfolio of assets that pay you reliably every month, whether you are actively involved or not. This isn't about risky speculation, chasing the latest trend, or trying to launch a high-growth startup that demands constant attention. It's about finding stable, predictable income streams that allow you to sleep at night, plan ahead, and maintain your independence. The principle is simple. Own things that generate cash flow consistently. Throughout history, people who built lasting wealth followed a similar pattern. They either created systems that produced money without their constant presence, or they bought into existing ones that already worked. The beauty of this approach is that it scales with age. As your capacity for day-to-day work decreases, your ownership and cash flow can continue to grow. Monthly income from reliable assets acts as a financial shield. It covers essential expenses like housing, food, and health care without having to liquidate investments or depend on unstable markets. This stability also opens the door to more freedom, traveling when you want, spending more time with family, or focusing on personal projects without the constant worry of running out of money. In the next parts, we'll break down 10 specific types of assets that can generate monthly income. Some are traditional, some are digital, and all can be scaled to match your goals and lifestyle. The key is to start small, prove the cash flow, and then build from there. One of the most powerful income-generating assets for someone over 60 is a small business that produces predictable, recurring revenue without requiring full-time involvement. The key here is not size, it's stability and ease of operations. Examples include self-storage facilities, laundromats, car washes, small bookkeeping or tax preparation services with loyal client bases, or local maintenance businesses that operate on monthly service contracts. Even a small website with paid subscribers or members fits this category. The common thread is that customers return regularly, paying for the same service over and over, which allows revenue to remain steady. These businesses often operate on simple models with minimal moving parts, making them easier to manage or delegate. Many can be run by a small team or even a single capable manager, leaving the owner free to focus on oversight rather than daily operations. The attraction for retirees is clear. Instead of trading hours for dollars, you're buying into a system that works whether you're physically present or not. As long as the processes are documented and staff are trained, your role becomes more about decision-making than doing. A smart entry strategy is to buy an existing small business that already has customers, systems, and staff in place. Look for opportunities where the current owner is retiring and willing to hand over the business at a fair price. Always demand at least 2 years of simple, easy-to-read financial statements, sales, expenses, and profit, so you can verify that the business is healthy and truly generates consistent income. If you can find a business that pays for its own acquisition loan while still leaving you with positive monthly cash flow, you've found an asset that can work for you indefinitely. It's the first step in moving from active labor to income by ownership. Not every asset needs to be owned outright to produce strong monthly income. In fact, for many people over 60, buying a minority stake in a profitable business can be a smarter, lower-stress way to generate cash flow without assuming full operational responsibility. This model works when you invest capital into a business that already has a proven track record, reliable systems, and capable leadership in place. In exchange for your investment, you receive a fixed percentage of the profits, paid quarterly or monthly without having to manage the day-to-day operations. The ideal candidates for this kind of investment are businesses that have stable demand and are not heavily dependent on the personal brand of the owner. Examples include medical practices with multiple doctors, regional service companies with long-term contracts, established e-commerce brands, or niche manufacturing firms with steady orders from recurring clients. The due diligence process is critical here. You'll want to examine several years of financial statements, talk to key managers, and confirm that the company has the infrastructure to operate smoothly without your involvement. Just as importantly, You'll need a clear legal agreement defining your role, profit distribution schedule, and rights as a minority owner. This approach can be particularly appealing for retirees who bring not only money, but also valuable experience. In many cases, your strategic insights and network can help the business grow, further increasing the profits you share in. The beauty of minority ownership is leverage. Your capital works for you inside a machine that's already running. You don't have to hire staff, manage inventory, or negotiate every contract. You simply own a seat at the table where the profits are divided. Over time, multiple small stakes in different businesses can create a diversified web of income streams that keep paying, regardless of whether you're traveling, resting, or pursuing other projects. Digital products with recurring revenue offer one of the most scalable, low-maintenance ways to generate monthly income, especially for those over 60 who may prefer not to manage physical operations or large teams. The appeal is simple. You build something once and it continues to sell many times over with minimal additional effort. Examples include paid newsletters, private membership communities, online courses, template libraries, or software tools that serve a specific audience. The model works because customers are willing to pay on an ongoing basis for access, updates, or continued value. This turns each sale into a long-term income stream rather than a one-time transaction. The barrier to entry is lower than many people think. A paid newsletter can be launched with only a few well-written issues and a clear niche audience. A private online group can thrive with consistent engagement and exclusive content. An online course can be recorded once and sold for years with periodic updates. The internet allows these products to reach a global audience, which means a small but dedicated customer base can still produce meaningful revenue. The key to success is choosing a topic or service that solves a real problem or fulfills a strong interest. For example, a retired accountant might create a subscription-based toolkit for small business owners, or a longtime gardener might build a library of seasonal planting guides and video tutorials. Recurring digital products require upfront work, but once built, they demand far less ongoing energy than traditional businesses. Marketing can be automated through email campaigns, partnerships, or social media. Customer support can often be handled with pre-written resources or outsourced to virtual assistants. For retirees, this asset has another advantage: location independence. Because there are no physical facilities to manage, digital products allow you to earn from anywhere, whether you're at home, traveling, or spending extended time with family. Over time, multiple small recurring products can combine into a steady, diversified monthly income stream that keeps paying for years. Residential rental properties have long been a cornerstone of wealth building because they combine two powerful forces: consistent monthly cash flow and long-term appreciation. For someone over 60, the right rental property can function as a dependable income source that also grows in value over time. The most common types are single-family homes, duplexes, and small multi-unit buildings. The key is to focus on properties in stable neighborhoods with strong rental demand. Areas near schools, hospitals, employment centers, or transportation hubs tend to attract reliable tenants year after year. The cash flow from a rental property comes primarily from monthly rent payments, which should cover the mortgage, if any, property taxes, insurance, maintenance, and still leave a profit each month. Over time, rents often increase with inflation, helping preserve and even grow your purchasing power. For retirees, property management is a major consideration. Unless you enjoy hands-on involvement, it's worth hiring a reputable property management company to handle tenant screening, rent collection, repairs, and emergencies. This transforms real estate from an active job into a mostly passive investment. The management fee, typically 8 to 10% of collected rent, is often well worth the peace of mind and time savings. Financing should be approached conservatively at this stage of life. A property should be able to pay its own loan and expenses without requiring you to dip into savings. Having a reserve fund for unexpected repairs, such as roof replacement, plumbing issues, or appliance failures, is essential to avoid financial surprises. One of the biggest advantages of residential rentals is that tenants effectively pay down your mortgage over time, steadily increasing your equity. Combined with potential property value appreciation, this creates a dual source of wealth. Cash flow now and a more valuable asset in the future. When chosen carefully, a single well-managed rental property can provide income stability, tax advantages, and a hedge against inflation, making it a valuable addition to a retirement portfolio. Commercial real estate offers the potential for higher cash flow and longer lease terms than residential rentals, making it an attractive asset for building reliable income after 60. This category includes office spaces, retail storefronts, medical facilities, warehouses, and mixed-use buildings. One of the main advantages is lease length. While residential tenants typically sign one-year leases, commercial tenants often commit to 3, 5, or even 10 years. This stability means fewer turnovers, lower vacancy risk, and more predictable income. Additionally, commercial leases often include clauses where tenants cover a portion or all of the property's operating expenses such as maintenance, property taxes, and insurance. These are known as triple net leases, and they can significantly reduce the owner's ongoing costs. Another benefit is higher rent per square foot compared to residential properties, especially in prime locations with steady foot traffic or strong industrial demand. For retirees, this can mean generating more income from fewer properties. However, commercial real estate requires careful due diligence. Market cycles, zoning regulations, and the financial health of prospective tenants all play a critical role in long-term success. Before investing, it's essential to analyze local demand trends, what types of businesses are growing, which areas have consistent tenant interest, and whether the property has multiple possible uses if the current tenant leaves. Many retirees enter commercial real estate through REITs, real estate investment trusts, which allow them to own shares in income-producing properties without having to manage them directly. Publicly traded REITs pay regular dividends and offer liquidity, while private REITs or syndications provide higher returns but require longer holding periods and more capital. For those willing to own properties directly, hiring a professional property manager or leasing agent can turn a commercial investment into a mostly hands-off income source. With the right property and tenants, commercial real estate can deliver a strong combination of monthly cash flow, appreciation potential, and tax benefits, helping secure financial stability well into retirement. Dividend-paying stocks are one of the simplest and most accessible assets for generating consistent income in retirement. Unlike growth stocks that reinvest all their profits back into the business, dividend stocks return a portion of their earnings directly to shareholders, usually every quarter, though some pay monthly. The appeal for retirees is clear. Dividends provide cash flow without requiring the sale of shares. This means you can maintain your ownership stake and still receive regular income, allowing your capital to continue compounding over time. Well-established companies that have been paying and increasing dividends for decades, often called dividend aristocrats, are particularly attractive because they combine stability with income growth. Sectors like utilities, consumer staples, telecommunications, and healthcare are known for hosting strong dividend payers. These businesses often operate in industries with steady demand, which supports consistent earnings even during economic downturns. The best dividend stocks not only maintain their payouts during recessions, but also raise them annually, helping investors keep pace with inflation. For someone over 60, a carefully selected portfolio of dividend stocks can function like a self-replenishing income engine. Reinvesting the dividends in earlier years can accelerate growth, while later on you can switch to taking the cash payouts to fund living expenses. An important metric to watch is the payout ratio, which measures how much of a company's earnings are used to pay dividends. A lower ratio generally means the dividend is more sustainable, while a very high ratio may signal risk if earnings decline. Investing in dividend stocks can be done through individual shares or via exchange-traded funds, ETFs, that focus on high-quality dividend payers. ETFs offer diversification and reduce the impact of a single company cutting its dividend. By combining dividend-paying stocks with other income-producing assets, retirees can create a balanced portfolio that delivers both stability and growth potential, ensuring that their money continues to work long after they've stopped working. Bonds and other fixed-income securities are a cornerstone of conservative retirement portfolios because they offer predictable interest payments and a set maturity date. For someone over 60, they can serve as a stabilizing force, balancing out the volatility of stocks and other higher risk assets. A bond is essentially a loan you make to a government, municipality, or corporation. In return, the issuer agrees to pay you regular interest, called the coupon, and repay your principal at maturity. This structure creates a steady stream of income that can be planned for months or even years in advance. There are several types of bonds to consider. Government bonds, issued by national governments such as U.S. Treasuries. These are considered among the safest investments because they're backed by the government's credit. Municipal bonds, issued by states, cities, or local governments, often with the added benefit of tax-free interest income. Corporate bonds, issued by companies, typically offering higher yields than government bonds, but with higher credit risk. For retirees, a bond ladder is a practical strategy. This involves buying bonds with staggered maturity dates, some maturing in 1 year, others in 3, 5, or more. As each bond matures, the principal can be reinvested into a new bond, potentially at higher rates if the market has shifted. This provides regular access to cash while reducing interest rate risk. Another option is fixed income funds, or ETFs, which pool together many bonds and provide instant diversification. These are more liquid and easier to manage than holding individual bonds, though they may fluctuate in value more in the short term. Bonds won't deliver the same growth as stocks or real estate, but that's not their purpose. Their role is to provide steady, dependable income and protect capital. In a well-balanced retirement portfolio, they act as a cushion, ensuring that you can cover essential expenses even when other assets are underperforming. To complete the list of 10 income-generating assets for those over 60, we'll cover two very different but equally powerful options: annuities and royalty streams. Both can provide steady income, though they operate in entirely different ways. Asset number 9, annuities. An annuity is a contract with an insurance company in which you make a lump sum payment or a series of payments in exchange for regular income, often for life. Annuities are appealing for retirees because they can create a predictable income stream that lasts as long as you live, eliminating the risk of outliving your savings. There are several types, but the two most common for retirement income are immediate annuities. Start paying income right after you make your investment. Deferred income annuities begin paying at a later date, allowing the value to grow in the meantime. While annuities can be a great safety net, they require careful selection. Fees, payout rates, and the financial strength of the insurer should all be evaluated before purchase. For many, annuities serve as a base income layer alongside Social Security and pensions. Asset number 10, royalty streams. Royalty streams are payments you receive for allowing others to use an asset you own, such as intellectual property, natural resources, or creative works. These can include book royalties, music rights, patent licensing fees, or even payments from oil, gas, or mineral rights. One unique feature of royalties is that they can be inherited, meaning the income continues for your heirs. Some retirees create royalty streams by developing their own intellectual property, while others purchase the rights to existing assets from creators or investors who prefer a lump sum payout instead of ongoing income. Royalties are often less correlated to stock market performance, which can make them a valuable diversification tool. However, they require careful vetting to ensure the asset will continue to produce income for years to come. By combining assets like small businesses, real estate, dividend stocks, bonds, REITs, annuities, and royalties, a retiree can build a diversified income engine that runs year after year. The key is to balance stability, growth, and risk tolerance, creating a financial ecosystem where money works harder than you do, no matter your age. If you've got here, subscribe to not lose on any of the tips to become rich after 60.